An empire doesn't collapse when things start to go wrong. It collapses at the very moment things seem fine. When the markets are still open. When the currency is still accepted. When the majority still believe that there's nothing to worry about. Financial history doesn't end with a big bang, but with a tiny shift in belief small enough to be overlooked, yet large enough to reverse an entire global order. Nearly a century ago, the world faced such a belief. The British Empire, with the pound at its center, was the backbone of the international financial system. London was where global capital converged. Britain could borrow cheaply, import more than it exported, and maintain a standard of living far exceeding its actual production capacity. Not because they were the richest, but because the world believed in their currency. And as long as that belief persisted, all warnings were dismissed as exaggeration. But belief doesn't fade with time. It breaks at a certain point. In November 1956, during the Suez Canal crisis, Britain didn't lose the war. The army didn't collapse. The government didn't fall. What changed was the market. Capital flows reversed. Foreign exchange reserves were rapidly depleted. The pound was sold off. In just a few days, an empire lost the financial privileges it had built over more than 100 years. Not by gunfire, but by the retreat of confidence. The frightening thing isn't the historical narrative itself, but the mechanism behind it. A central currency allows the nation to issue spending first and pay the price later. When that mechanism is questioned, the price doesn't immediately appear in the headlines. It seeps into daily life, prices rise slowly but steadily, savings lose value, living standards fall without a clear moment of collapse to name. People simply feel that life is getting harder, even though the economy on paper continues to grow. And that's why the story doesn't end in 1956 Britain. Because today, the US dollar is still in the position the pound once held. US Treasury bonds remain the cornerstone of the global financial system. But history poses an uncomfortable question: if confidence in a central currency begins to crumble, where will the first signs appear, and will we recognize them in time, or only realize it when things have already changed? Looking solely at the numbers in financial news, it's hard to believe the system is at fault. The US dollar remains the world's #1 reserve currency. US Treasury bonds are still considered the safest asset. The stock market hasn't crashed. The economy is still growing. Unemployment remains significantly lower than during past crises. All of this creates a familiar feeling: America is fine. That very feeling is the most important surface layer of any currency crisis. Before confidence breaks, the system always functions well enough to convince the majority that the risk is merely an academic assumption. For most investors and the general public, there's no reason to panic as long as the currency is widely accepted, as long as the US Treasury is still selling debt, and as long as there isn't a major event to call a break point. The most common argument today revolves around a familiar phrase: there's no other option. No currency is large enough to replace the dollar. No bond market is deep and liquid enough to compete with the US Treasury. No financial system is stable enough to play a global central role. And so, all warnings are dismissed with a simple conclusion: the world must continue to use the dollar, whether it likes it or not. But this is the logic that defended the British pound for decades before 1956. At that time, London was also the unrivaled financial center. The pound was also considered the only option for trade and reserves. It was believed that even if Britain weakened, the world would still need the pound to run the system. And that belief persisted until it ceased to be true. The key point is, monetary privilege doesn't collapse because a perfect replacement appears. It weakens when actors in the system begin to seek ways to reduce their dependence, however small. It's not because they believe in a better alternative, but because they want to mitigate risk if the old order fails. On the surface, things are still functioning. But underneath, behavior is beginning to shift. In the surface picture of America today, these changes aren't large enough to constitute a crisis. They appear scattered, asynchronous, and are often interpreted as isolated incidents. But history shows that before confidence is lost, the market doesn't send out loud signals. It quietly adjusts, little by little, while the mainstream narrative continues to assert that the system is solid. The surface picture is always the most deceptive part of the financial cycle. It reflects the past more than the future. And it is this outward stability that causes risk indicators to be downplayed, until they connect to form a completely different story. When a financial system enters a risk phase, the first signs rarely appear in macroeconomic reports. GDP continues to rise. The labor market remains healthy. Aggregate indicators still show a functioning economy. But alongside those numbers, people's real lives begin to tell a different story, slower, quieter, and more undeniable. This disparity is precisely the space where monetary crises can develop. Nominal wages may rise, but real purchasing power does not. The prices of food, housing, insurance, healthcare, and education escalate faster than income. Years of accumulated savings begin to lose value, not because of a shock, but because of sustained inflation. People don't say the economy is collapsing, they just say everything is much more expensive than before. In previous cycles, this phase was always underestimated. Because, on paper, the system was still functioning. But it is the disparity between real-world experiences and the macroeconomic narrative that erodes social trust. When people no longer perceive the benefits of growth, confidence in policy and the currency begins to weaken, even without a concrete event to assign blame. The history of Britain after 1956 clearly illustrates this. After losing its central monetary status, Britain did not immediately descend into chaos. Instead, it experienced 2 decades of weak growth, persistent inflation, constant pressure on the currency, and a relatively declining standard of living compared to other economies. Nominally, the system remained intact. In reality, society was paying the price for losing its previous financial privileges. A noteworthy similarity is that during this period, much of the policy debate revolved around the idea of everything being controlled. Monetary tools were used to alleviate short-term tensions, while the long-term costs were gradually distributed to holders of money and fixed incomes. This isn't a collapse, but an asymmetrical adjustment process where the burden isn't evenly distributed. In the United States today, this disparity is becoming increasingly apparent. People feel the pressure of rising living costs outpacing income improvements. Small businesses face higher capital costs. young people have less access to housing than previous generations. But these experiences are often detached from the narrative of the dollar, public debt, or monetary privilege. They are seen as social problems, not systemic ones. Monetary crises don't start in financial markets, they start in real life. As the gap between data and experience widens, social trust erodes. And once that trust weakens, the financial system, however large and deep, becomes more vulnerable to further shocks. The discrepancy between macroeconomic data and real life doesn't arise by chance. It's a direct result of a long-standing structure where fiscal and monetary policies and the role of the central currency are intertwined. To understand the current risks, one needs to look directly at that foundation, rather than just observing the symptoms on the surface. First, there's the fiscal structure. The United States maintained a level of spending exceeding revenue for a long time without immediate consequences, because the dollar allowed the government to borrow on a large scale and at low cost. When a country issues a global reserve currency, deficits are no longer an early warning sign. They become the normal state. The problem only arises when the scale of debt and interest costs begin to directly compete with essential future expenditures, from infrastructure investment to education and labor productivity. Next is the role of monetary policy. For years, economic shocks were managed by loosening fiscal policy to stabilize markets. This approach was effective in the short term, but left a long-term consequence. Asset prices rose faster than incomes, and inflation became a silent adjustment tool. While inflation was used to soften the debt burden, the real cost was passed on to holders of cash, savings, and fixed incomes. Finally, the most crucial element, monetary privilege. The dollar allowed the United States to import more than it exported, consume more than it produced, and finance that imbalance by issuing debt to the rest of the world. For a long time, this mechanism created outward stability and a high standard of living domestically. But it also made the system deeply dependent on the confidence of external actors, who bought the debt and held dollar reserves. As long as this confidence remained intact, any tensions could be postponed. But when stakeholders begin to question not verbally, but through actions, the system begins to feel pressure. Diversifying reserves, changing payment methods, or adjusting holdings don't need to happen massively to have an impact. If done sufficiently, and on a large enough scale, they will alter the cost of maintaining the old order. The danger of systemic causes lies in the fact that no single decision causes a crisis. Each policy has its own rationale within its context. But when accumulated over time, they create a structure where risk is pushed into the future, while benefits are enjoyed in the present. And at some point, that future begins to backfire. When systemic causes accumulate sufficiently, their impact extends beyond national borders. With the central currency, even small changes have global ripple effects. And it is at this level that signs of adjustment begin to become clearer, not noisy, not uniform, but moving in the same direction. In recent years, the behavior of central banks has changed remarkably. Instead of simply optimizing yields and liquidity, strategic safety has become paramount. Increased gold holdings, reduced reserves in a single currency, and the pursuit of more flexible payment structures reflect a new defensive mindset. This is not an action against a specific country, but a natural response of systems to concentrated risk. Simultaneously, international trade has begun to exhibit detours. Bilateral payment agreements in local currencies, regional clearing mechanisms, and digital experiments in cross-border payments all point to a common trend, reducing dependence, albeit only partially. None of these systems are large enough to replace the existing order. But they don't need to replace it. They simply need to exist and function as needed. Importantly, these changes don't require the collapse of the dollar to be justified. They occur within a context where the old order still operates, but the costs of maintaining it are beginning to rise. Each diversification decision is a risk management choice. And as the number of such choices increases, a ripple effect begins to form. History shows that central monetary systems rarely lose their role because a superior competitor emerges. They lose their role when the rest of the world is no longer willing to bear the full cost of maintaining that center's stability. When the burden is dispersed, order becomes less secure, even if outward appearances remain unchanged. At this stage, what is noteworthy is not political pronouncements or public messages. What is noteworthy is the quiet, consistent, and sustained adjustment of behavior. This is how large systems change, not through declarations, but through repeated actions. In most financial cycles, the most dangerous risks aren't the widely discussed ones, but rather those considered insignificant because they don't cause immediate disruption. Mainstream media often focuses on growth, inflation, employment, or short-term market volatility. But currency crises often develop at less noticed points where liquidity, confidence, and market behavior intersect. One such point lies in the system's ability to absorb ever-increasing volumes of debt without altering market structure. When debt issuance becomes commonplace, the question is no longer can it be sold, but at what cost and to whom. If that cost gradually increases, or demand becomes less stable during sensitive periods, pressure will begin to build, even if everything appears to be running smoothly on the surface. Another point lies in the role of underlying support mechanisms. When the market becomes accustomed to always having a final support, risk doesn't disappear, it just moves. It shifts from the surface to the foundation. In the short term, the system is more stable. In the long term, expectations of intervention alter behavior, making subsequent shocks harder to control. This is the price of artificial stability, a price often only seen when confidence begins to waver. There are also political and institutional risks, which are rarely included in financial models. When fiscal and monetary decisions are dominated by political cycles, policy consistency diminishes. For a central currency, that consistency is its most important intangible asset. When it is questioned, the market reaction doesn't need to be immediate. Hesitation at crucial moments is sufficient. These risks are difficult to convey in single numbers. They don't create a shock within a single trading session, but they increase the likelihood of scenarios where the system wasn't designed to handle them quickly. And because they're not part of familiar scenarios, they're often overlooked until it's too late. Every monetary order ultimately stands or collapses because of a single factor: belief. Not emotional belief, but operational belief, the belief that tomorrow others will still accept this currency, buy this asset, and finance this system as they do today. When that belief remains intact, conflicts can be delayed. When it begins to crack, the rate of change in the system accelerates exponentially. A crisis of confidence doesn't start with mass panic. It begins with hesitation. Investors don't sell off immediately, but reduce buying. Institutions don't withdraw capital en masse, but adjust their holdings. Central banks don't declare a change in order, but increase reserves. Each individual action is rational. But when repeated on a large scale, they create a chain reaction. Hurricane psychology in finance doesn't operate in a linear fashion. In the long run, nothing happens. Then, at some point, even a small signal is enough to trigger a strong reaction. The danger is, when confidence shifts, familiar policy tools lose their effectiveness. Measures that were once sufficient to reassure the market may no longer work when the core question is no longer what's the price, but should we hold it or not? Monetary history shows that such moments are rarely recognized in due time. Most crises of confidence are only named after they have occurred. Before that, they are often explained in neutral terms: correction, rebalancing, technical volatility. But for the system, it is the moment when the rules of operation change. With a central currency, a crisis of confidence doesn't necessarily lead to an immediate collapse. It can lead to a prolonged period of higher costs, greater instability, and less control. But it is this shift in sentiment that is the real turning point. Because once trust is no longer taken for granted, every decision within the system becomes more cautious and the old order no longer operates with the same speed and efficiency as before. The history of currency doesn't operate like a curse, but it leaves very consistent traces. Central currencies don't disappear overnight. They weaken through rational short-term decisions, necessary compromises at each stage, and deliberate delays in addressing structural issues. By the time the cost becomes clear, society has often entered a new state where every choice is more expensive than before. Britain after 1956 didn't collapse. But the British people endured decades of painful adjustments: low growth, persistent inflation, a weak currency, and a standard of living lagging behind the rest of the world. It wasn't the collapse of a nation, but the loss of a privilege once taken for granted. And what's remarkable is, that price wasn't paid in a dramatic moment, but was distributed gradually over time, silently but persistently. For the United States, the central question isn't whether the dollar will lose its central role overnight. The question is how the cost of maintaining that role is increasing, and who will bear that cost. While monetary privilege remains intact, problems can be delayed. When that privilege begins to erode, problems that were pushed to the future will return with greater intensity. The most dangerous thing is not changing the order, but denying the possibility of change. History shows that systems collapse fastest not because of a lack of tools, but because of the belief that this time will be different. It is this belief that obscures early warning signs and delays a response when the breaking point appears. The final lesson isn't just for policymakers or financiers. It's for society as a whole. Because when the monetary order changes, the impact doesn't stop at the market. It impacts prices, savings, jobs, and opportunities for future generations. Understanding this mechanism isn't about predicting the day of collapse, but about identifying risks while there's still room for adjustment. History doesn't repeat itself, but it rhymes. and the rhyme of past central currencies reminds us that no privilege is permanent, and the price of delaying this realization is always far higher than facing the truth sooner.